When investors see a long streak of green days, optimism masks the foundation's deterioration. But when inflation compromises an investment space, the structure fractures. This chart tracks that deterioration using a metric called real earnings yield. To find this, we take a company's actual profit and subtract the current inflation rate. When prices rise faster than earnings, the math reveals a negative zone that nominal gains cannot hide. To navigate this environment, capital begins a rotation. Investors look away from paper assets and seek sectors with high mechanical efficiency and reliable output. Before mapping out the data, a quick reminder: this video from Capital Casualty is for educational purposes and does not constitute financial advice. Historical data shows that ignoring these macroeconomic cycles often leaves the market blind to incoming corrections. By looking at past cycles, we can diagnose the current state of capital. This archival photograph features a chart showing inflation rapidly crossing into double digits in the 1970s. This period demonstrates how severe inflationary pressure alters the baseline for growth. This graph compares stock price against actual value. The left curve looks positive, but the right shows true purchasing power declining as inflation erodes margins. This creates a valuation gap that cannot be maintained. When this gap finally shatters on the trading floor, the resulting panic reflects the market's realization that its assets lacked a physical floor. Market health is ultimately determined by real earnings yield. In every historical cycle we've tracked, assets with high nominal valuations but negative real yields are the first to drop. When peak valuations begin to damage the broader economy, central banks reach a trigger point. They are forced into aggressive intervention to stabilize the currency. Documentation from past shifts shows the mechanism of this policy: raising interest rates to curb speculation. This forces the economy to restructure around businesses that can survive without cheap debt. Rapid interest rate hikes cause immediate friction. Global supply chains built on low-cost borrowing begin snapping, requiring them to realign into more efficient configurations. This bar chart compares the resulting growth. The stagnant 1970s sitting next to the exponential recovery of the 1980s shows the result of an economy that has finally recentered around industrial output. While central bank policy halts the immediate crisis, a true recovery requires mechanical innovation and the rebuilding of physical industry. This transition moves capital away from abstract financial services and into tangible manufacturing and infrastructure. This flowchart illustrates how heavy industries manage inflation. Because their products are essential, they pass costs to the market, protecting margins. These supply chains become primary drivers for national GDP velocity, as output remains constant when credit is tight. The resources extracted and refined here become the fuel for the entire industrial cycle, making them the most durable assets in an inflationary environment. Rotation involves leaving overvalued tech multiples and embedding capital into the industries that drive the physical economy. On a macro level, capital follows these trade routes. Investment flows away from services toward nations managing the world's physical logistics. This globe heat map shows the shift in growth. Regions with high industrial output glow intensely bright, while service-heavy markets that rely on debt begin to fade. Trade statistics show capital actively leaving regions sensitive to inflation and seeking out these industrial hubs. We see this in the movement of resources across borders. Capital prioritizes nations with the robust manufacturing and shipping infrastructure required to move physical goods. This concentration of trade suggests that the next economic cycle favors the markets that maintain physical control over the infrastructure of commerce. The data highlights a consistent trap: chasing high nominal valuations during an inflationary cycle. Survival in this cycle depends on a single core rule: connecting capital to real physical growth engines. Evaluate your strategic positioning. Are you relying on the resilience of the physical economy, or are your assets held in sectors vulnerable to inflation? Preparedness in the current market requires a focus on tangible assets. If you found this data-driven breakdown useful, subscribe for more documentaries on the macroeconomy. Understanding these historical cycles provides a reliable compass for navigating the rotation of global capital.